Hello and welcome to this edition of Inside Out on the Road, a show where we focus on individual stocks with in-depth analysis. We deep dive into the financials and we also highlight all the key risks and triggers going forward. Well, let's get straight to the first stock today. My colleague Sonal, she gives us this very special deep dive on landmark cars. Let's go across.
Inside Out today is going to focus on Landmark Cars, which is an automotive retailer in the country and deals with various brands, be it Mercedes, be it Jeep, BYD, Renault, some of the commercial vehicles for Ashok Leyland as well. There's Volkswagen, Honda as well for the company. They have around 117 outlets, 10 states and around 28 cities as well in which they function. In terms of the financials of the company now, let's talk about them. Their pro forma revenues, they've increased from around 1956 crore rupees in FY19 to levels of 4500 crore rupees in FY23, and at the halfway mark they've done revenues of around 2054 crore rupees. These are pro forma revenues. We'll discuss it in greater detail what that exactly means. But in terms of EBITDA, they have grown from 120 crore rupees in FY21 to 250 crore rupees in FY23, and at the halfway mark at 104 crore rupees. At the halfway mark, the profits are at around 28 crore rupees. This compares with FY21 profits of 11 crore rupees and FY23 profits of around 85 crore rupees. What is the next thing that we are watching out for? Well, the demand depends on demand that we are seeing in the luxury car market, and that is something that we'll be tracking very closely. And the working capital cycle of the company, ex-Mercedes, how do they track it? How do they manage it when the demand is weak? And a lot more. We'll understand all from the management in this conversation, and we'll take a deep dive. Understand everything about Landmark Cars, what the company does, what is the business model and the strategy going forward as well. We have with us Mr. Sanjay Thakker, who is the chairman, promoter and executive director at the company. Mr. Thakker, such a pleasure having you on the show. Thank you so much for joining us and explaining to us and our viewers in detail about Landmark Cars. So, that's exactly my first question. What is your business model really like, and what is the revenue split? How is it different for Mercedes, because that is one of your biggest clients as well?
So we have basically two pillars of business. One is the sales and the other is the after sales or the service. So the sales comprises of a sale of cars where the company gets a commission. There is an insurance premium. 90% of the people who buy the car buy insurance from us. And then there is a finance. Most of the guys in India, 75% of the guys who buy the cars take finance. So we get a revenue stream, a commission from banks for that. And then we sell accessories. You will see a lot of accessories in our showroom, and that's what people end up buying too. So that is the first revenue stream. And then there is another revenue stream of after sales, which comprises of accident repairs, the periodic maintenance and general repairs, which is a very high margin recurring annuity type of a business that we do.
So you spoke about Mercedes. Tell us, how do revenues work there? How are they different from the other brands?
So in case of Mercedes-Benz, the after sales business continues the way it always did. In the sales part of the business, we get commission every month on the cars that we end up selling. We don't make the margin of buying and selling, but a commission comes straight in our books. Now the advantage is that there is no working capital requirement for Mercedes part of the business, and that's why the ROC looks better and it becomes much healthier.
Okay, so what is the margin difference between Mercedes and non-Mercedes brands?
So on a gross level basis, one needs to see the margin and then take out in normal business what we do with, say, a Honda or a Volkswagen or any other. There is an interest cost and there is a discount element.
Correct.
So actually what one should be looking at is what is it that we retain at the end of the day. So with Mercedes new model, it is a better situation where we do not have any interest and any discount whatsoever. So the gross margin is not the exact way of looking at the stuff. In sales, we look at approximately 2 to 3% of retained margin.
On Mercedes,
on all the things blended.
Okay, on blended it's around 2 to 3% is the retained earnings, so to say, that you get there. So how does it differ if you do your sales from new vehicles versus the existing ones? Does it matter there as well? Because analysts say that if you increase your new vehicle sales, that would increase your ROE, or that would increase your retained earnings as well.
So there is a kind of operating leverage that we are looking at. So the same showroom needs to generate more sales. And once the sales goes up, and which is what India is all about. So this showroom where we started, we have been significantly increasing the throughput of the showroom. Now that's where the growth will come from. That's where the operating leverages will kick in.
Got it. So Mercedes is still the bigger client for you? How can you split the revenues in terms of brands?
From the pro forma revenue basis, that's what we will have to look at. It is our biggest brand. Clearly, it is the biggest brand. Approximately 35 to 40% of the group's pro forma revenue comes from Mercedes-Benz. But this number keeps on changing year on year, depending on what new brands we add. What new locations we add, some new models of the existing brands coming in, and that's not what we typically look at. But as we speak, Mercedes is clearly our biggest franchise.
So, I'm going to ask you about the plans that you have. You spoke about outlets, so what the expansion plans are. You put out a release recently as well. But, luxury market is still around 1% of the passenger vehicle market, around 45,000 units sold last. How do you think this market will grow? What are the trends that you've seen in last couple of years? Because you've actually catered to this industry for more than 2 decades. What are the changes that you've seen in how customer changes in buying patterns?
So luxury starts where necessity ends. I mean, that's what people talk about. And the mood of the nation is buoyant today. This is, people believe, and I think rightly so, that it is India's time now. And if that's the mood, then this 1% penetration is a joke. Really, we can't be at 1% penetration. 45,000 in all luxury cars is really the tip of the iceberg. We have seen that the base is getting broader. We actually had a pyramid kind of a thing, which you have seen that the vehicles above 10 lakhs are selling much more than the small cars. So this is where we believe that this 1% can become significantly large. It is 7% in China. Of luxury car penetration. They sell 2 million vehicles. We are 40,000, 2% of what they do. So we believe this is a long journey that we have started, and it's good to be at the right place, right time.
So you are seeing, what kind of growth levels are you seeing, if you can compare it over
So the luxury car market has grown twice, thrice as fast as the passenger car market. And the popular belief is that is something that will continue. And for maybe a decade or so. And all the luxury car OEs are focused now on India. This is one of the few shining beacons in the world kind of ecosystem, and we are seeing additional focus coming on India.
Okay, so you spoke about how it's easier to manage working capital with Mercedes because you do not hold that inventory with you, or you do not show it in your books, so to say.
Yes.
How does working capital generally work for other brands? What are the working capital days? And is there an industry standard here when it comes to luxury cars and the working capital?
So the working capital comprises mainly of the stock of cars that we will hold. We will have also working capital on the demo cars, the test drive cars that we need to hold. Now that's the sales part, and in the after sales we have the inventory of spare parts. That's what we hold, which is not in rupee terms not that meaningful. But for new cars, for a healthier balance sheet, one must look at less than 1 month of new car stock, and the demo cars comprise generally around 12 to 13 days of your sales. That's something what one needs to figure out.
Okay, interesting. So let's talk about your expansion, because you've entered the southern market now with your recent expansion plans. How do you choose which market to go to, whether the showroom there should be on rent or you should own that particular property? What is the strategy here?
So in India, the rental yields are significantly lower than the interest rates. So Landmark as a philosophy, since the time we started, has believed in renting places, paying the market rent, and running a profitable business. We have been an outlier in the industry where people generally want to buy real estate. We have not been that. So out of the 117 locations that we have now, only 2 are owned for Landmark. So the philosophy is not to buy property at all for faster expansion and to track profitable growth, per store growth. And southern markets is something that we always wanted to be. Hyderabad has been a go-to market for us. It's amongst the fastest growing luxury car market, not only cars, but for luxury goods, I would say. So I believe that once now we have entered with Mercedes-Benz, we will do meaningful things over here. To answer your question as to how do we choose the market, we choose the market based on the growth potential that the market offers. And the rentals, what is the per square foot rental?
Okay, interesting. So there's a lot to talk about your expansion plans, but I have to take a look at the workshop as well because this is an integrated facility. So let's go there and understand more about the other side of the business as well.
Sure, let's do that.
So we are here at the workshop. Tell us more about how big is it as a part of your overall revenues? What is the strategy with margins here and outlook going forward?
So the workshops are a very meaningful part of every auto retailer's business in India. 70% of our revenue was sales and 30% was after sales some time back, but the margin is absolutely reverse. We make 40% gross, 18% EBITDA margin in this business. This has been growing at 20% CAGR for us for the last 9 years. And we don't see this kind of stopping anytime soon, because the more cars we add on the streets, the more they will come back to us. The authorized dealerships are the place where customers go for their service, their accident repair. This integrated facility also does accident repair work, where there is a high quality paint booth and a lot of other equipment that the general local garages would never have.
Okay, so you know, when we're talking about aftermarket sales service, there's insurance that you spoke about as well. How do take rates differ there? Do you have revision in take rates in different segments on a yearly basis or on a half-yearly basis?
So, as a company, we have several products that basically keep the customers loyal to us. There is an annual maintenance contract. There are extended warranties which are there. The customers our experience is that till around 7 years or so, customers keep on coming to the authorized dealerships. And as the car park grows, this is something that we believe is an annuity type of a business which will keep on going and going. The margins broadly remain the same.
So pre-owned cars, that's also a big part of your overall strategy,
yes.
right? You've guided for 100 crore of revenues. How is it in the overall picture? What are the plans here in terms of, say, CapEx or the brands that you would add here?
So, as we spoke, we have as of now 2 pillars of business. One is the sales and one is the after sales. We want to add the third pillar, which is the pre-owned cars as a meaningful business. In India, that business for auto dealerships currently isn't a meaningful part. We want to change that. And what we believe is that we will be focusing in a very specific way of selling our own brand cars rather than going to the open market and spraying and praying. So we will be focusing over here in this facility of buying and selling pre-owned Mercedes cars. And this business can actually grow significantly large because there is a dearth of reputed certified vehicles which is backed by organized retail, and that is a void we will want to fill.
How big would that market be, if you can give us an
In
idea?
India, the pre-owned car market is 1.3 times currently than the new car market. So by a rough estimate, it is over 5 million vehicles.
Okay.
So this is, we are just scratching the surface of this, and this over a period of time will become significantly meaningful for us.
So that's a big opportunity that
Great,
you are
great
tracking.
big opportunity, yeah.
So there'll be a lot of capex plans in that case. You know, you're talking about expansion into the southern market. You've opened new opportunities for brands like MG as well. Give us a sense of what capex plans are and what would that do to your free cash flows?
So the good part is that we are sitting on decent amount of cash. We raised around 150 crores in the IPO. Last year, in the full year, we generated around 120 crores of cash. That pace continues even in the current year. And the capex for us has always been funded through internal accruals. We have never borrowed or don't intend to borrow for investment. So that is well taken care of. As far as the pre-owned car inventory is concerned, that's the only thing that we need to be focused on. We have allocated only around 25 crore rupees to buying and selling of these pre-owned cars as a working capital. As we sell, we will buy. So that is the model that we are looking at. We are comfortably placed as far as the cash is concerned to take care of our expansion.
Okay, comfortably placed as far as your cash is concerned. Would an inorganic opportunity excite Landmark Cars?
It excites us no end. So this is something that we have been doing successfully, I would say, for the last 20 years or so. And 30% of the outlets that we have had are acquired outlets. So there is enough and more opportunity in the market, and we'll be very happy to kind of push our pedal on that.
Your average revenue per vehicle serviced, it has increased to 25,000 versus levels of 22,000 last year. Where do you see that going, since you're saying the annuity business and you know these are predictable revenues?
So what Landmark has been doing is to focus on car care products, on value-added services that the customers really want, and they never got it from the authorized dealerships. We have also been cutting down our business of small cars. We have shut some outlets where we were the per car throughput was not so meaningful for us. That has taken it up. We are focusing on premium and luxury products, and the mix, once it changes in favor of the luxury and premium, this revenue will keep on going up. We don't have a number to tell you now, but that's what we are focused on all the time.
All right, that was a deep dive into Landmark Cars. But it's time to slip into a short break. We'll be back with another interesting stock. DCM Shriram Industries, that's the stock on our Swotlight segment. You don't go anywhere. Welcome back to Inside Out. As promised, let's get straight to our Swotlight segment. Well, the company on our radar is DCM Shriram Industries. And the question is it fully valued, or is there scope for value unlocking from here on? Let's tell you a little bit about the business first up. Well, the company houses a sugar and distillery vertical, which manufactures high purity, double refined sugar, and also has modern facilities to produce country liquor and IMFL on demand on contract manufacturing basis. Well, they also have a chemicals vertical, which is involved in producing high value, high technology drug intermediates. And the third vertical appears to be the most exciting, and it's also the fastest growing vertical. That's the one that's focused on industrial fibers and engineering products, which also is related to defense production. Well, the financials appear to be pretty average in the last few years. High single digit revenue growth, and margins have been in mid single digits, while the debt appears to be around 300 crores. That's majorly working capital in its sugar business. Hence, on a trailing basis, it appears to be fairly valued, trading at around 22 times on a trailing basis its net profit, and an EV upon EBITDA at around 11 times EV upon EBITDA. But after diving a little bit into the financials, we understand that sugar contributes the highest on the revenues front, but at the lowest in terms of margins. While the industrial fibers business, it contributes close to around 20% to the entire revenue scheme of things, but the highest in terms of EBITDA margins and also the highest in terms of EBITDA contribution. Well, the chemicals business, it contributes close to around 20%, and it's around double-digit margins. Well, the management in August 2023, they announced restructuring of its businesses. They said that there'll be 3 listed entities which will be divided into DCM Shriram, which will house the sugar as well as ethanol and power businesses. The other 2 businesses will include DCM Shriram Fine Chemicals as well as DCM Shriram International. That will house the rayon business, which includes defense as well as the engineering projects. Now, the rationale that's been given by them is they want to provide scope for independent growth. They want to unlock some shareholder value because they're looking at better price discovery of each and every business. They also say that this facilitates succession planning in an orderly and a strategic manner as well. The big question is, will the street give a higher value to the demerged entities as its industrial fibers and related products division has been growing at a very fast clip, and operating leverage as well could play out? If you look at the EBIT in the first half of this fiscal, well, it's more than the EBIT that they achieved in the entire of last fiscal. Additionally, what needs to be seen, how big can the defense vertical become as they are forayed into defense manufacturing under the Make in India theme. And they plan to set up a fully integrated facility to produce equipment for defense as well as homeland security organizations. Well, let's wind this down with the shareholding pattern then. Promoter entity, well, they hold roughly around 50% stake, while 9% is held by institutions which include LIC as well as Abacus Emerging Opportunities Fund. Well, we've completely run out of time on this episode of Inside Out. It's goodbye from Sonal and myself. But you keep writing to us, tell us about companies you want us to discuss. We'll do some research and try to feature some of them on the show. Thanks a lot for watching.